my late 30s to early 40s, I kept getting this urge that, look, I must be able to do something creative. And for me, something creative meant starting something of my own.
When you are transitioning from having a safe environment and a safe earning month on month to do something which might be risky, which today it's happening, but tomorrow it might not happen. How were you doing emotionally at that time?
Every employee to entrepreneur transition is going to face that issue. And instead of being a salary earner, you're now paying for somebody else. And it's a very painful transition, meaning suddenly you're responsible at the month end for payroll.
When you were going from being an employee to an employer, did you have that cushion, or you were like, man, I trust myself and I'm just going to go ahead and do it?
If you think you'll break even in 2 years, be prepared for 3 or 4.
Okay, Mr. Narinder, happy to have you on the show.
Happy to be here, Rafael.
First question, of course, I would like to ask you. You have worked in Hindustan Lever, you have worked in several different organizations before, and then you went to start your own venture. And you have then exited that venture, and now you are mentoring, you are an angel investor, and you're mentoring a lot of startups in different parts of the world. But before going to your exciting career, I would love to understand how your childhood helped you get to a place where you are at today.
That's an interesting question. I have to go back several years, if not decades. So, I guess my childhood was actually in a small town in India, in Pilani. And I grew up literally around research scientists and professors. And in normal course, I would have expected to follow the sort of the family line and go into science, electronics, engineering, which I did in the first. My first master's was in physics, and then as I was so pretty much from the time I was born to the time I completed my master's in physics, I was in Pilani all along. And Pilani is, as I said, really a research and education town. But as I was going through BITS Pilani, the university that I went to, I realized that there were a lot of other things that I was interested in, particularly in management. And one of the things that stood out was that BITS, or Birla Institute of Technology and Science, had a very flexible, I would say, American style program based on MIT that allowed you to experiment with your courses. And I realized along the way that I might make a better manager than I might make a scientist.
Okay.
So even though my dad was a bit disappointed that I was not continuing into a PhD and do research, at some stage he realized that I would be happier as a manager, and that is where I went to XLRI for my MBA, and then, as you referred, I joined Hindustan Lever as a management trainee.
Amazing. And how was your experience? Because Hindustan Lever was not the only organization you joined, right? Like you went from Hindustan Lever to another organization, after that another organization later as well. After going through all of that journey, what was that moment where you were like, okay, I'm ready to start on my own?
So I think I was between my late 30s and early 40s. I started getting this urge that I need to do something of my own. And I mean, I was doing well as a manager, working for other people, growing professionally. Moved from Hindustan Lever to Hitachi in Dubai. Had 6 glorious years there, and then moved to Singapore. But all along, from my late 30s to early 40s, I kept getting this urge that, look, I must be able to do something creative. And for me, something creative meant starting something of my own. And it was a big urge, I would say that. And the term I used to sort of state that is I wanted to move from employee to entrepreneur. And I think Singapore gave me that opportunity when we came here in 1996. I started my first venture with my then employers, and happy to say that it didn't go well. but I learned a lot. But started another venture with my wife, which did well, and that company still exists. And then the third one was the largest, which was Utopia Global, which lasted for 18 years, was global literally in every sense. And so I've done three ventures, out of which one was a huge learning moment.
Was that the one with your wife?
No, fortunately not. That would have been a painful learning moment. No, that one did well. Uh, but the first one, which I started with my employers, and when we go through the conversation, I might refer to that as to why that didn't do well and what, and a huge amount of learning that I got from that one failed venture.
Amazing. And that was when you were working for someone and then you started working for yourself. Within that transition, what was your main feeling? Because essentially, when you are transitioning from having a safe environment and a safe earning month on month on month to starting to do something which might be risky, which today it's happening, but tomorrow it might not happen. How were you doing emotionally at that time?
So I think that's a really good question, and I think every employee to entrepreneur transition is going to face that issue. And instead of being a salary earner, you're now paying for somebody else. And it's a very painful transition, meaning suddenly you're responsible at the month end for payroll, and that's not easy. But I would say that both the ventures, my first two, especially the second one that I did with my wife, which was called Avina Resources, now called Avina Holdings, we started in some ways small. We started with a small team of 4 or 5 people. We were implementing software for small and medium enterprises. We were recognized by the government of Singapore as a service provider, which allowed our clients who were small and medium enterprises to get almost 70% of our fees paid by the government. So there was some help along the way, I would say, in that sense. We kept a close watch on our expenses, and we sort of started getting used to being employers rather than being employees. But it takes time, and it's a huge responsibility. And later, when we did Utopia Global, I mean, there we had 650 people, and there that the load on your shoulders is much more. And you not only think of it as 650 people, but if you assume that 650 people are three-person families, you're talking of nearly 2,000 people that you're responsible for. So, but you sort of grow into it. But I guess the point you're trying to ask and I'm trying to make is that you do need to understand that responsibility.
Absolutely. And that leads me to a question which might be personal, but would love to also understand for people who are in this journey now, who are employees and want to start their own ventures. There still needs to have a cushion of some resources for you to either be safe, to start something of your own, because there is always a chance that things might not go well. when you were when you were going from being an employee to an employer, did you have that cushion, or you were like, man, I trust myself and I'm just going to go ahead and do it?
I think a little bit of both. So I did have some savings that helped in the initial period, but also we are also a two-income family, so that was to in a certain way another cushion. And I think our businesses, especially the first two, were such that we were able to get by. But it was extremely painful when we did the big Utopia Global, because that was a multi countries. We were like a micro MNC. We had huge expenses. We were trying to grow into new markets, especially markets like the US, which are extremely expensive. And that was one time when I remember that my personal bank account was down to $500.
Oh my god.
So that is something that one has to go through. And I think the question you're asking is right, that people need to think of that, and also think of the fact that it'll always take longer to reach break even than you think. If you think you'll break even in 2 years, be prepared for 3 or 4.
Yeah.
And also, if it makes sense, and we can discuss that as well. seek money from family and friends to cushion the transition.
Absolutely, absolutely. Investment money and friends and family, of course, do come in handy. But did you, when you were starting out with the first organization on your own, um, did you take any investment, or you just started on your own completely?
So, sort of chronologically, the very first one, the one that I did with my employers, I didn't need to take money. We were together in it. I was the junior partner, they were the senior partners. And when we started Avina Resources with my wife Bindu, that time we didn't really need a lot of money
Mm.
because it was I mean, and the other point I'm going to make is that a lot of businesses that have been started by professionals over the years have not been too capital intensive. They have been brain intensive.
Yep.
That you were using your brain power to think of something, think of a new gap in the market, and come through with it. And particularly IT-based businesses, which are among the largest today, or tech-based businesses, those really relied on a lot of just brain power, good education, and a small team of people that you could start with. The other
True.
point that I would make is because it affects cash flows, that there are multiple ways of also looking at cash flow, which is one of the most critical things when you start business, whether it's for paying for employees or whatever. And simple things like tighter payment terms with your clients, asking for an advance, or seeking a bank line of credit, are other things that you can do along the way to cushion the impact of what you're going to face.
Absolutely. And since you're talking about, you talked about Hitachi, you were working as a senior regional marketing manager. So we have a marketeer in house. I would love to ask some marketing questions, but we will get to that in a bit. But right after that, you started Gateway Computers. Is that the venture that you started off with your employers at that time?
No, Gateway, I was an employee. I had prior to that started a venture with a company called Ajiv Group, who
Achieve.
had brought me to Singapore. So
Got
that
it.
venture I had started with them, and that is the one which we went into hardware and things like that, IT hardware, I would say.
Got it.
And that is where I burnt my fingers and learned the
Okay.
lessons. Gateway, I went back to working as an employee, looking after
Wow.
11, looking after 11 countries in the region. But it was at Gateway that I got the idea for starting Utopia. And I
Mm.
was on a visit with a group of colleagues to India, and that is where the idea of, hey, there's a gap in the market, maybe I can try to fill it. So that is so Gateway was instrumental in my coming up with the idea to start Utopia.
Amazing. Because Gateway, I see that it's a computer hardware manufacturer, and Utopia is a data service organization. So, how did you find need in the market when you were in such a different business, but of course, it still is complementary?
So I'll have to give you a little bit of a story behind it.
Let's do it.
So when I joined Gateway in the year 2000, uh, one of the things I noticed, and I was heading the regional business. So one of the things I noticed was that Gateway was not present in India, and India in those days was still very early in growth. And I went up to my bosses, who are the managing director of the region, and said, "How come we are not in India?" And I got a very smart, quick answer saying, "I can sell more in Shanghai than I can sell in India," and which is true. But I also told him that, look, India's situation was changing. There are early signs that India will be way bigger than it is today. And therefore, I think we should at least start getting in. So, about 6 months into that, in July of year 2000, we put together a team which included people from the US. And along with it came somebody who used to run the US call centers.
Mm.
And his brief on the team was, if we are going to go to India, can we leverage the US call centers, the Indian call centers with the price advantage to take calls from the US? So we visited a lot of call centers in addition to visiting and saying, hey, how do we set up Gateway India, and how are we going to staff it, and what products we will sell? We were also simultaneously doing meetings in Delhi, Mumbai, Bangalore, Chennai, meeting call centers. And while we were doing these meetings, I realized, and this is back in July of 2000, that uh, that in India, a lot of people under the Y2K umbrella had put up call centers but had no business. They did not have customers. So basically, if I can sort of simplify it, a lot of rich fathers had put money into call centers for their children, thinking that this was the up and coming. And in those days, a 200 seat, 300 seat call center was considered big. 5,000 was huge. So I came up with this idea that look, this is a white space where the capacity exists, but the customer doesn't. So if I can bring the customer, then I don't need to set up the capacity. So it would
True.
be what uh, colloquially you would call an asset light model. And you are also not talking of millions of dollars of investment in infrastructure and hardware and software and training of nothing of that because you are going to outsource that. So that is how Utopia started. We started as a call center company, something you won't find anywhere
Yes.
in our current thing. And from there, there's a history to how we got out of call center and how we got into data, and that's another long story. But one point I do want to leave you with here is, I was able to leverage my previous experience from Dubai, which was a big trading hub, and we used to trade even in Hitachi. We trade with places like Iran or Iraq or the region, and we were trading hardware, which was Hitachi home electronics, video equipment, AV, all that. But we were not manufacturers. And I applied that experience here to services to say I don't need to own the call center, but I can own the customer. So
Yeah.
instead of trading in hardware, I can trade in services. And that is how I came up with the idea of the call center, and then spoke to someone in the US to be my co-founder, who also was my brother or still is my brother. And he had just exited his first business. And we set up this company, Utopia, in 2003. And we still remember the date because it was 3/3/03,
Wow.
3rd March of 2003, uh, to set up this company primarily as a call center company. And
That's
the other
awesome.
point I want to make around that is that almost every entrepreneur will go through a time where they will find other opportunities that the market will throw at them. And they should be flexible and alert to those opportunities. And as the commonly used word is, pivot to those opportunities, which may not be the very first one that you thought. But you need the first one to get into the market, but then
Absolutely.
listen to the market.
Yes, absolutely. I think that's a very great point. And I would also like to ask you something along the lines of that, because essentially you never thought of starting a call center, and you were just listening to the market and the market needs, and you were like, okay, there is this white space, and I want to solve this white space, and this is how I can do it. Do you also think that there is a spiritual element involved to that?
I think it was more logical. I think the spirituality came in handy later when we hit bumps.
Yeah.
At that time, you need the backing of spirituality and your upbringing and all of that and emotional intelligence. But I think this was more logical to say that, look, I've been wanting to do something. Here is a white space. Going back to the previous point, doesn't require millions of dollars. We
Yes.
can trade in services. We will own the customer, but we don't need to own the back end. And so those pieces, which today look pretty simple, had to fall into place over a period of about a year or so.
Amazing. And when you started that, your transition from being a call center to a data company, what was that transition like? Because, of course, a business model of a call center is, as you said, it's light assets. Like, you don't really have to invest millions and millions. But as soon as you transition to a data company, you need the tech, you need the
Yeah.
resources, and you might also need millions of dollars to build a product that is presentable to the mass market, because then you need hardware, you need software, you need storage, etc., etc., etc. How was that transition from a call center to a data led company?
So this takes me to the point about listening to the market
Hmm.
first. So when we went to our first set of customers were in the US, and we went to those customers, my co-founder, my brother, and I, and we had another co-founder at that time. We'd go to these customers, and in the US, through my co-founders, we had good access because they had worked in good companies themselves. So we had good access to companies, even including companies like Kraft, where both of them had worked.
Yeah.
And then we went to other companies through, initially you get your contacts through friends and family, through professionals, through whatever, right? You are not known, you don't know, but you get that. And one of the things we found was that they would always talk to us about their data issues. So they would talk about call center because we were there for that, but they would also talk about their data issues. And they almost thought, and and it is a bit of a stereotype, and I'm going to say it as it is without being politically correct, that they saw on the team, the three of us co-founders used to go, of which two were of Indian origin, my brother and I. So
Yeah.
they assumed we knew IT. That was the stereotype working in our favor. And they would ask us deep tech questions, which we didn't always know the answers to because we were from science and engineering background and we had done some computer science along the way, but we were not computer scientists or IT people. So in the first two or three, we said, no, no, we are here to sell you call center services. We don't know what you're talking about on data. By the fourth customer, we said, yes, we know what you're talking about. And we then followed our current model at that time of being asset light. We went back to India. We looked for companies who understood what the customer was looking for on data. And we started getting into data first at really foundational level, like doing data cleansing, data enriching, data quality work as it is called. So we started like that. And again, we started it by giving it to other people in India while we owned the client and the client relationship. So we very gradually transitioned. So our call center business kept going while we were developing the data side of the business, which later became a lot more complex and a lot more sophisticated than data quality. But again, in that transition, and I'll come to it again later, in that transition, we again did not have to invest millions of dollars because we were using third party data providers whom we were teaching what we wanted done.
Yeah.
So it was a gradual transition to data quality to start with.
And when was the moment where you realized that, okay, I just want to focus on data and no more of the call center, or you continued both till the end?
So I would say starting in 2003, by about 2005, 2006, we had realized that call center A was a very high volume, lower margins, competition was going up, and it was real time work. So there was also a lot of complexity in the sense that if one of your call center agents made a mistake, you'd get a call in the middle of the night to say, "Oh, somebody messed up. I lost a customer. Something happened." Right? It was real time, and problems were real time. Plus, the margins were going down, and our data practice was picking up.
Mm.
And in 2005, we decided that even the asset light model on data will not work because A, we want to do much more than the Indian providers were capable of doing. Plus, we realized that we were sitting on a gold mine of IP that we'll be creating. We wanted that to be in-house, and therefore in 2005 we set up Utopia India Private Limited so that we could bring in-house all the expertise that we wanted to develop around that. And from then onwards, it was data all the way.
Amazing. And all this time you were based in Singapore, right? You were based in Singapore, but also you had partners in the US, but the company was in India.
So the company's headquarters and parent company was always in the US. The first entity that was set up was a US entity. And everything else, we later had six subsidiaries. They were all subsidiaries of the US parent. So
Ah,
India also was a subsidiary of the US. And
amazing.
then we had subsidiaries in places like Canada, UK, Dubai, obviously Singapore, and India and Australia.
Amazing.
So, so those were set up as subsidiaries to the parent. And was I living out of Singapore? Yes, 60% of the time I was in Singapore, and 40% of the time I was traveling, and visiting customers. We had a huge focus on staying in touch with the customers. So I would do, initially we couldn't afford that much, but later, in later years, I was doing 300,000 miles a year of travel.
Wow. Okay. And the reason why I was asking that question is because, of course, economies of scale. If you're operating out of India versus your customers are paying dollars, Sing dollars, Australian dollars, it just makes a massive difference in scaling your business.
Yeah, I mean, not only in margin, but also in availability of talent.
Absolutely.
So when you scale your numbers, you need talent in good talent in large numbers, and that's not always possible in every country.
Amazing. Now let's get deeper into Utopia and let's understand how you really built that business. Because, of course, in the beginning, you already had traction from the customers you were already having on your call center side. But when that was done, how did you start gaining more customers? What was your go-to market strategy after you had drained all the referrals that you had?
So I think that's a challenge that every startup faces. And in our case, uh, again, we are talking back in 2005, 2006, 2007, that era. It was still an era of trade shows, for example. It was very little online even at that time. It had started, but not too much. So we started attending trade shows, particularly in the US, and also in the Middle East. So for example, in the US, we also tried and were successful in tying up with SAP as a partner. And then we started attending, even though it was a lot of money for us at that time, we take the smallest booth possible and be at SAP Sapphire trade show, which is their largest trade shows in Orlando every year. So I think our first trade show was back in 2006. But then there were other trade shows that happened along. Even for that matter, if you're familiar, Dubai for years has had the GITEX
Hmm.
trade show, which I think is typically around October. So we started attending that. We started attending for a few years. We even attended the Oracle trade show. So our one of our big pushes into getting new customers was through trade shows. In addition to that, we would look for speaking engagements. We'd look for uh, paid or unpaid advertorials, things like that. So those were some of the methods that we used back at that time. Today, those methods may be very different.
Yeah, yeah. But today you will just look at Facebook, yeah, YouTube, run an ad.
Yeah.
If it's B2B, you'll do LinkedIn and do a cold outreach. Of course, the things have changed a lot. And at that era, you really had to hustle and really had to sell every opportunity you used to get. And that, of course, brings me to a point of pricing because pricing is so technical. And whenever I ask this question to anybody here, they always talk about trial and error. How did you price your product? Because it's a B2B product. What was your pricing strategy to price your offer and service?
So we are a different as compared to other IT companies because now we were more and more becoming like an IT company, an IT services company. We were becoming and behaving like an IT services company. But we had one advantage that we were not IT people in terms of computer science graduates. We were business MBA backgrounds, all three of the co-founders, and particularly two of us who later stayed on and one left. We all had sales, marketing, and MBAs. So we looked at it as a business. And even when it came to pricing, the easiest pricing mechanism, so there are a few ways of doing pricing. One is cost plus, which is the easiest. You take your cost, you say, I want to make 25% margin, you do that, your pricing is ready.
Yeah.
The other is look at competitors and then price it either higher or lower than them. The third is what we used to call market-based pricing or value-based pricing.
Mm.
What is it that you're delivering to the customer and what do you think you can charge? And was there some trial and error? Yes, there was some trial and error, but we almost never did cost plus pricing, which
Mm.
also meant that when we were talking to a customer, and over time our services enlarged, right? I mean, over time you're not doing only one service, and I can describe that a bit later. So we would, even within one proposal, we could have had 70% margin on one service and 30% margin on another. Because because based on market conditions, based on where the customer was sensitive to pricing, where the customer wasn't. And not only that, there were areas where we were clearly innovators and leaders. And in the areas where we were innovators and leaders, we would generally not drop the price. So I wouldn't want to give a number out, but we had very high gross margin throughout the history of the company.
Amazing.
And that really helped us because we were able to plow that margin back into growing the business instead of all the time going and looking for new money. We did not take any external money for the first 9 years of the business. We suffered a lot personally, but we never took money for 9 years. And one of the reasons that was because we had high gross margin, because we were a differentiated business, and we were innovative in what we were doing.
Amazing. Why did you say you suffered a lot?
Well, the easy path, I think, sometimes is, hey, why don't I go raise money? It'll give me a salary, uh, things like that, cushion, as you called, cushioning the transition. But we felt that we wanted to hold out and hold on to equity as long as we could, because when you eventually sell the company, you don't want to be left with, how would I put it, left with 5% or 10% of the equity, because you have now given it all away to investors. And in doing so, you do have your employees to pay first. So if you have a cash flow issue, you're going to pay your employees and not get paid yourself. So we had at that point in time in our difficult years around 2008, 9, those years, where we had employees who were drawing $250,000 salaries, but there were months when we co-founders could not draw a single dollar. So that was why it was tough personally.
So, since you talked about listening to the market and listening to the marketing needs, my next question was around retention. How do you make sure, or how did you make sure in that 18 years of experience with Utopia, how did you retain a customer and what were some strategies that you used?
Sure. So there were a couple of things I guess that we did. One was you do need to have, because we were initially in the services business, later in the software business, software and services business. In the services business, you can only retain a customer as long as you have services to continuously offer to the customer, right? So if your services have a one-time use, then you obviously can't retain the customer beyond the one-time use. But in our case, we were able to add services along the line. We started with data quality, we went to data migration, we went to master data governance, and then we had software for master data governance. And once we brought in the software, you are then sort of there, you're connected to them every year, throughout the year. You have annual maintenance contracts, you give them updates, you do all that. And then you also do continuously find more work. But I think that's on the product side, that you need product to remain engaged or services to remain engaged. But I think the bigger issue that maybe alluded to earlier was also that you should have trust and good quality execution. So you need both of those to exist for the customer to continuously come back to you. Keeping in mind that especially the very large customers that we were dealing with, they had and they still have very strict rules around procurement. They cannot just give you the order, even though you're doing well. They need to bid it out. They need to do all that. So you still need to earn your place on the team. But it is something, if you are good at your work and they can trust you, I think you have a higher success rate of winning that business and staying with them.
So, since you talked about trust, one of the biggest things that maintains that trust with other organizations, especially if you're in a service business and a product business, is the people working in your own organization. So, when it comes to hiring, what is that one main attribute that you see before hiring someone?
So, since our whole company, both internally and externally with customers, placed a lot of emphasis on trust, honesty, integrity, these are sort of similar attributes. We would definitely look for that in the people you are hiring. And that would come through in the hiring process, both in terms of what they claimed, what they were open about, and how they interacted culturally, also whether they would fit with our team or not. And we would arrange almost 4 to 5 interviews pretty much for every hire, so that it was a two-way street. We could get multiple views of them and their cultural fit, trust, those issues. And likewise, they could speak to 4 or 5 people on our side and get an idea of what it would be for them to work in our company. And I think we were, I would say, largely successful in hiring those kind of people.
Got it. Um, and when it comes to hiring, it's very critical, right? Like how you hire and how you nurture and how you retain those employees. What was like, how did you make sure that you could retain a candidate that you were like, yes, this is the one who can actually grow in my organization and simultaneously grow my organization?
So I think for that we had a few things we would do. Firstly, we were very careful at the hiring stage, but more importantly, once we hired them, we were careful in nurturing them, and nurturing even very senior people, because our business was in many ways unique. The services we were offering and the software we were offering was unique. So we would never get people who were just straight off the street and they could start working tomorrow. So we had a proper onboarding, we had training, and then we would align everybody to the company goals. And a couple of things in that. Firstly, at a company level, we would share how the company was doing, good or bad, openly with our people. Our team, down to the lowest employee, knew what our revenue was, knew where our new customers were coming from, knew where we maybe had a problem with the customer. Everything was shared. And we had different forums for it, like a managers meeting, all hands meeting. We would have an all hands meeting 2 or 3 times a year where we would get questions from all over the world from our employees. And we would make an effort to answer each one of them. Sometimes those questions ran into 3 pages, but we would answer them. And I would also say that in retention, it is important that people see growth. And
Hmm.
since we were continuously growing as a company, we were able to provide that growth to our team. And I do think that in that personal interest that we took in our people played a big role. So I would say that at the end of 18 years, we had a very strong backbone of people who had been with us 10 years or more. And these are not people who could not have got a job somewhere else. They could have got a 20-30% increase anywhere, but they stayed with us because they saw a future. Many of them got overseas postings. Somebody relocated to Australia, somebody relocated to Canada, US, UK, because we helped them get green cards, we helped them do other things. And on the financial side, every employee down to the lowest had about 30 to 40% of their uh, annual comp linked to company performance. So in the years that the company did well, they got a lot of bonus. In the years we didn't do well, well, they didn't get that much. But
Yeah.
we were all aligned. The founders were not the only ones making money. If anything, we were the ones to last get any money that was left over after we had paid our employees. So not only that, I would say when we had 2 exits. One, we had a small exit in 2012, and then we had a bigger exit in 2020. In both cases, we had in the first exit, I think we must have had about 50 employees who got stock options paid off at that time. And in the second exit in 2020, we had about 100 people who received money as part of the sale due to stock options. And the number of people who called me and said that that money paid for their down payment of the apartment they wanted to buy is not funny. So many people would message, call, and say, this really paid for our down payment. And it was
Amazing.
serious. It was not just few rupees here and there or a few dollars here and there. It was, and for those who were not on stock options, we gave each one of them a token payment uh, when we had the exit in 2020. So nobody was left out. We also had another system. Again, this is part of a. I can't answer your question in 2 minutes, but I'm just sharing another thing. So anybody who'd been in the company 10 years or more, even if he was housekeeping staff, had stock options.
Wow.
So there were people who called us and said they had never seen so many lakh rupees in their account when the company got sold in October 2020.
That's amazing. And that's a part of the trust that you were talking about, right? Because essentially, when people knew about the finances of the company, people knew what's going on, then they would, of course, trust that the money that we are getting is the fair amount of money or fair amount of share of wealth that is being dispersed amongst the employees.
Yeah.
Having said that, how did you make sure the trust stays? Because essentially, when the company is sold off and somebody else is taking over, you usually don't have that control over the trust. How did you make sure if the employees stayed with the same organization will be treated fairly?
So that was part of the due diligence on our side while we were working with the acquirer uh, to see that there would be a smooth transition. And now, in any such acquisition, you can try for a smooth transition, but at the end of the day, there can be different styles.
Yeah.
So our style was a more trust, very open, very wide, wide range conversations with people. Their style was not as much like ours, but I would say the bulk of the people are still there 3 years later, which means that we did a good job of settling them there. There were also a few interesting cases where, again, I come back to trust, and I'm sharing just a few examples. So, for example, in the US office, there were 4 or 5 people who were in the final stages of getting their green cards.
Hmm.
And in the transition, we made sure that the acquiring company and their HR understood that whatever happens, you please do not let go of these. If you do a retrenchment or you do a downsizing, these people need to be kept in the company for the next 6 months so that their green card comes through. So that is the level of understanding you need to have of your people. And all of them got their green cards and all of them settled in, including one in the UK. And does it happen accidentally? Surely not. It happens because you're interested in their welfare and you think that their families want to stay, whether in US or UK or Canada, because now that is where you brought them.
Yeah. And that brings me to a very interesting question, because this is something that I've always been dabbled in. Because there are always two philosophies of managing people. One philosophy is where you treat them like family, and make sure that their needs are met. And one philosophy is that you treat them like a basketball team, where if somebody is not performing, you bench them. If they're not needed, you just exit them. Which philosophy do you think most gets the most results, let's say?
I think each company and each management team has to decide their own. So I don't think that there could be a clear black and white answer. And the reason I say that is because it's a package of things you do which work for you.
Yeah.
For example, if I were to describe our management style, we were very friendly. We looked after our people, including personally things like, hey, do you get a green card? Do you do this, do that? We
Exactly.
down to that level of detail. But were we demanding? We were absolutely demanding. So we
Hmm.
didn't want to create a culture which is just collegial culture. Okay, it's okay if you come to work. It's okay if you don't. It's okay if you mess up. It's okay if you don't. So we didn't have that. So we had accountability as one of our values in the company. Look, you have to be accountable. Now, does that mean that we sometimes had to ask poor performers to leave? Absolutely. And I do think that, as you said in a basketball example or anything, if you do not remove the poor performers, you're also going to get the good performers to slack off, because they're going to say, what difference does it make whether I'm a good performer or a poor performer? That's one
Yeah.
reason. The second is, one poor performer on a customer project can bring the whole customer project down. It just needs one person. It doesn't take a team to pull a project down. So, but even in that, we had a friendly approach. We would give people feedback, written and verbal. We'd put them on the very famous performance improvement plan.
Goodness.
And I would say 50% of them would come through and stayed with us for years after a performance improvement plan, and 50% of them didn't. And
Hmm.
uh, and I make no excuses for saying that. Look, sometimes you do need to let the poor performers go, so long as you have addressed issues which could have caused their poor performance.
Absolutely, because essentially it's still a business, and you have to make sure that even the team who is working, putting in the effort, they get the return that is actually required. And of course, that brings me to the question of, as you grew the organization, how did you start leveraging newer technology, and how did you make sure that you stay abreast with those technologies?
So I think we made a very conscious effort in that. And I'll give you one or two examples. So as we grew, for example, the easiest examples are from IT. So our IT needs grew. So we would reach out to IT vendors and understand what the latest was. There was a time when our business was growing and we needed better quality servers, and then we went for the best IBM servers that were available at that point in time. Then as we grew, we realized that look, we need to put stuff on the cloud, and a lot of our services and even our own work had to be done on the cloud. We went for machine learning and artificial intelligence, which could not have been done uh, by us investing in a lot of computer hardware or servers, and you know how expensive those are. But going to the cloud made that possible for us. So we would very consciously look out for new technology. And one example I can give you is that we were using a cloud provider out of US. We had by then, this I'm talking about 5 years ago, and we had about 120 servers that we were running on the cloud, which was big for a company of our size. And we were not getting what we needed to do. And we finally switched to AWS, and we
Hmm.
transitioned over 120 servers to AWS over a period of 2 months and got the full benefit of a cloud provider, which had an unexpected benefit for us that we were at the same time building up our machine learning team. And we
Yeah.
started using AWS servers for our machine learning. So it was a very conscious effort to be at to use the latest technology as it was relevant to us.
Absolutely. And of course, like on the same tangent, would love to understand, like you have seen all the stages of business growth, right? You started small, it went big, then you also exited, and there must have been stages where you were like, okay, we went from zero to this to this to that. In general, how did your strategy change with each of the stage of growth of the business?
So I think first there was a thinking of how to grow the business,
Yes.
and in our case we were very focused on data and enterprise data, and within that, as I said, we had concentric circles of data quality, data migration, master data governance, and finally software sitting on top of everything. So one way was, so you also have to look at it not only from a growth perspective but also from a risk perspective. So if you are totally focused on one domain, you are at a fairly big risk as a company, because if for any reason those services go out of fashion or they get replaced by something else, then you would hurt quite badly. So in our case, we made the conscious choice that we will de-risk the business by sticking to our domain but adding new geographies. So
Hmm.
we added, as I said, Canada and UK and Middle East, and in fact, some of our biggest customers were in the Middle East,
Hmm.
out of UAE, out of Saudi Arabia, and out of also out of Australia. So we did a growth. Our growth was also based on de-risking. So we did de-risking through geographic expansion, and we would also look at that time the growth to see which market was good for what kind of services. And back to your original question, which market was good for what kind of pricing,
Yeah.
because some markets were very price sensitive, and we always thought of ourselves as a premium product,
Yeah.
and we would not drop our price below a certain stage, so we would not go into those markets. But there were other markets like the ones that I mentioned which were good for our business. They had an appreciation for what we were doing, and we would then grow into those markets. And when we wanted to grow into those markets, we would check on the market dynamics, we check on pricing, we check on hiring people in those markets. All our front facing staff, customer facing people were always locally hired. We did not just transplant them from US or India, which were our two big centers. So we
Amazing.
always hired locally.
That's great. Um, and that leads me to a question, because you talked about two exits. Like, when do you start dabbling with an idea of an investor, and when should you?
So it really depends on what your goals are. right? I mean, some people, I'll give you an example. Some people want to run their company forever and hand it over to their children.
Yeah.
Okay, that's one model. That's not very common in IT, but it is common in the more traditional businesses. The other model, which is more common in IT, especially companies our size, is that when you become too big or become bigger, you start hitting against the big guys, the
Yeah.
big four, five IT companies, and they start to notice you. And then at that stage, they start fighting you in the market. When you're too small, they don't fight you because they think you're irrelevant. But as you become bigger, and as especially in a situation like we had, where we would win our data migration or software or data governance business against them, and we would many times even win at more expensive than them. So we were not just a price player; we were able to convince a large customer that we were better. So I guess when you're doing that, you really have to be careful that at some stage you are ready to either make the company grow a lot bigger, which is possible, and many and all the big companies have grown like that. That at some stage the owners decided that they'll take external money and grow it. Or in our case, what we did was after 9 years of running it in 2012, we sold 40% of our company to a private equity firm. And the reason for that was twofold. We wanted to get money into the company for more growth, but we also wanted some money to come into our personal bank accounts because till that time we had not made any significant money, or as I was sharing, there were years or months when we were not even drawing a salary. So I think we were trying to balance our personal balance sheet versus the value in the company. And eventually, I guess at some stage, you either commit to the very long term, and we thought 18 years was long enough for us, that
Yeah.
we were open to a complete exit of the remaining 60% that we own. Now, when does one think of it? I can only give you a few guidelines that, as far as possible, take money when you need it, but slightly before that, so that when you are so that you are not on the ropes when you go looking for money. You start thinking
Yeah.
of when you need the money in advance, so that you can reach out to investors, you can reach out to banks, you can reach out for lines of credit. And taking equity is not the only way of getting money. There are many other ways of getting money where you
Yeah.
don't dilute your equity. That is one thing I would say. Be protective of your equity. And I work with a lot of founders right now as an angel investor, and that is one of the pieces of advice I give them. That deal with a bit of short-term pain, but keep equity so that when you have a big exit 4 or 5 years down the road, you get a sizable payoff rather than all the investors getting the payoff and you are still pretty much where you were.
Yeah.
Uh, so I think it is almost for each management team to decide when when they're ready to either take some money or even let go completely.
Amazing. And of course, that leads me to another question, which is, when are you starting your new company?
I think having run for 18 years, 14-hour days, 300,000 miles of travel every year, I don't think I'm starting a new one of my own. But to
Hmm.
me, in this phase of post exit, I'm really enjoying the fact that I'm able to work with founders that I invest in. Some I don't even invest in, but they come for advice. So it's really interesting doing that. It's good to see how that is there. Plus, I'm getting to see newer business models. I'm getting to see newer domains. I've invested in a wealth tech company. I've invested in a multi-channel communication company. I have invested in a blockchain NFT company. So there are
Wow.
a few like that I have invested in. There's a cybersecurity company as well. So it's nice for me to go back to our earlier conversation that I should continue to learn from the market and learn to see what is going on in the market rather than what I did, 18 years, 20 years ago.
That's amazing, sir. And how does philanthropy plays a part in all of that? Because of course, like all of the years, excuse me, and all of the times we look at, okay, we got to make the money, we got to give back to our people, our families.
Yeah.
When was that point for you where you were like, okay, I also want to give back to the society?
So I think in our case, partly because of upbringing and partly because of events, as a company, we started giving back to society in a very small ways with our first give back of $750 in India. and that was back in 2007. And
Okay.
then we converted. In India, there was a program called the Joy of Giving, and then we adopted that name. And every year in October, independent of the main Joy of Giving program, we would run a Joy of Giving program in Utopia every single year.
Wow.
And we would collect money from our employees, and we would top up with a company grant. We would later, as we became more sophisticated, we even started going to our vendors and saying, why don't
Yes.
you contribute to our Joy of Giving collection?
Amazing.
So we were able to generate quite a few $1,000s, which we then split between India and US, because those were our two main markets. And we would give money to local charities. And there were some charities, particularly out of Bangalore, where we were supporting them like 100% of the food that they needed for the children that they were supporting, things like that. We were working with a food pantry in the US, where we would also go and do volunteer work at the food pantry, once or twice a year. So I think that was more when we were doing it at Utopia. And post Utopia, my wife and I have been very focused on giving back in the field of education. So we started in a small way by taking on or rather giving scholarships to our former employees of Utopia, their children, and we are still doing that.
That's
And
amazing.
there's a school in Pilani that we now support in a fairly significant way with both ideas and finances. So I guess that is one thing that an exit allows you to do at scale, rather than $750 that we started with.
Absolutely, sir. Um, and of course, if if somebody is at a place now where they are working for someone and are trying to go work for their own selves and start something of their own, what would be your advice for those people at this time and age?
Right. So I would say one is that you have to start. Uh, Give me just one second. That
Yes, sir.
one thing is that you have to start. I need to tell somebody I'll be a bit late.
Yes, sir. Please take your time. And we are just finishing in the next 4 minutes.
Yeah, I'm just delaying it by 15. Okay. Yeah. So for somebody who's starting now, I would say there are a few things to look at. Firstly, obviously look at a domain and an area that you understand. Ideally, you have spotted a white space, and you think that, look, from my experience, and from my skill set, here is an area that somebody is not doing. To use my example, I saw call center facilities but no customer, so I saw that as an open space to start. And then later we saw the data being something the big companies were not focused on. The other thing I would say, and I'm a strong believer in that, it's not like commoditized businesses don't make money. Commoditized businesses do make money at large scale. But for the kind of businesses that we are thinking of or talking of, professionals turning to entrepreneurship, I think knowledge businesses make more sense. So you don't need a lot of money for that, but you do need your knowledge, your skills, your brain power, which has driven most of the innovation in the world, starting from smaller to larger companies. And I would say do that. And importantly, be as much as possible, be a differentiated business.
Hmm.
Avoid the temptation of doing something that 300 other people are already doing.
Yes.
And even if you're choosing something to do which 300 other people are doing, make sure that your way of going to market, whether it is in delivery, whether it is in pricing, whether it is in speed of execution, there is something unique about you that even in a commoditized business, somebody will prefer you over somebody else.
Yeah.
And if you can be in a specialized business, that to me is the best, because then you have fewer competitors. You can charge the price you want. You have, you have security that at least in the near future, you are not facing big competition, and you are able to do innovative work for your customers. Finally, I would say be very mindful of cash flows, because it's very easy, particularly for people who don't come from a business background. Maybe they come from a non-business background and they're starting their own company. They sometimes lose track of cash in the bank. They think
Yeah.
that they did $1 million sale, but the $1 million are still sitting in the customer's account and not
Yeah.
transferred. So you can run out of money. And when companies start running out of money, a lot of bad things happen, including you need to bring in people at very low valuations, you lose control, you get people, every Tom, Dick, and Harry starts giving you advice because now you're seen as a founder or a company which is not doing well. So I think there are ways in which you can get your cash flow to work well, but be very careful of that. Lastly, I would say, and this is something I've also seen successfully in my angel investing business, that you must have a co-founder.
Hmm.
Being a sole founder is not as good as having at least one co-founder. You can have complementary skills. You can also have complementary personalities. You can address different parts of the business. And not only that, if one person is feeling low or down, the other person can, pull him or her up, and likewise the other way around.
Yeah.
So I know of some angel investing or VC funds which today insist that companies have a minimum of two founders,
Hmm.
and they do not even invest in companies. And I have started doing the same. I see the value in that. In my own experience, I had co-founders with me, and I think we added to each other's energy, and we also helped each other during the dark days, which you are guaranteed to have.
Yeah. Absolutely. That was beautiful, sir. If somebody wants to reach out to you, how do they reach out to you?
I have a presence on LinkedIn. So if somebody was to go and look up my name under Narinder J Singh, they'll find me there, and I'd be very happy to respond to them. I do get messages from founders quite often, and I'd be happy to interact with more founders.
Absolutely. I'll also add your details in the description below. But Narendra sir, it was such a pleasure to have you here and listening to your wonderful thoughts and the amazing work that you have done. It was an honest pleasure. Thank you so much for being here.
Well, thank you very much for having me and organizing this. Thank you. And